Hi guys, this is Constance from Zoa, and today we're looking at expenditure. In particular, we're looking at expenditure that medical practitioners can claim. Now, we're not saying that only medical practitioners can claim these expenses, but the slant or the angle that we're for this particular video is for medical practitioners. So if you are a medical practitioner, this is for you. Anyone who has run a business inevitably has to manage the tension between the desire to show healthy profits in their business with the desire to pay as little tax as possible. I'm sure a lot of you can relate with that, and medical practitioners are no exception. Now, what is one of the things that is quite pertinent to medical practitioners is the fact that they usually have minimal expenditure that they can claim through their businesses, because really their greatest asset is their skill and intellect. And so usually you'd find that they don't have much in terms of overheads, and if any of their, so whatever expenses that they have through the business depends on the structure and way and how they're working. If they are working from within a hospital environment, then you'd find that the equipment that they are using belongs to the hospitals and that the doctors are affiliated to. And so, as we know, any prescribed medications are paid either by the patient or by their medical aid. So again, that's another expense that is not the doctor's expense to put through their business. So in a nutshell, for that reason, the medical practitioner will often have limited costs that they can put through the business. And then this means that their taxable revenue that is in the business tends to be high. And any expenses would be limited to things such as rent, telephone or communication costs, the costs of their software, accounting and billing software, as well as any payroll related expenses. And again, we know that usually medical practitioners will employ a receptionist and not really have a high number of employees. Now, we want to, in many instances, in the case of sole practitioners, we know that certain expenses cross the border between personal and business use. And this includes, for example, motor vehicles. And this is something that is not limited to medical practitioners, by the way. The same with cell phone expenses. These costs are often hard to separate in terms of business vis-a-vis personal use. So what do we mean by that? We mean that the practitioner uses their vehicle to drive to the office, but also to drive to, let's say, they have sometimes they are on locum, or they have to go to different hospitals, not the usual working place. They have to drive to those places, and the same with their cell phone costs. So you'd find that they use their telephones or their cell phones for both personal as well as business. So the question is, how do you separate the business vis-a-vis the personal aspects of that? And so now, when it comes to cell phone expenses, if the business related costs are at least 51% and the owner can prove that, then the general rule of thumb is that the business is allowed to bear the full cost of the cell phone. With regard to motor vehicles, I think we need to go a little bit further into detail because it's not quite as easy. SARS has prescribed what is known as the fringe benefit rule, and it is important for business owners to understand these rules. Now, vehicle ownership, we're going to discuss three options regarding ownership of a vehicle. The first one being that the vehicle, a scenario where the vehicle is owned and registered in the name of the company, which attracts what is called a fringe benefit. The second option being where the vehicle is owned and registered in the name of the taxpayer or the individual, and the company pays the individual either a fixed travel allowance, or they might pay them a reimbursement for their specific travel. Now, the third option is where the vehicle is owned and registered in the name of the taxpayer, and the company pays what I've just mentioned, basically the individual a reimbursement allowance for the actual expenses incurred. In other words, the actual business travel. And we're going to look at these in a little bit more detail. Now, when a vehicle is owned by the company and used by the taxpayer, who is the medical practitioner in this case, for both business and personal use, it gives rise to what is called a fringe benefit with respect to personal use of the vehicle. And what that means is that when the individual uses the car, they sometimes use it for personal travel, and at other times they use it for business travel, and so there's blended use there. And so there is a formula to calculate the value of that fringe benefit, and that formula is prescribed by the Revenue Authority. Now, employees may be entitled to claim a reduction on that fringe benefit in respect of actual business mileage traveled. So while SARS will impose a certain predetermined amount as a fringe benefit, which is a taxable amount in their income tax or in their remuneration for the year, they do have leeway to reduce that by the actual business travel for that year. In order to claim such a deduction, an accurate record of mileage needs to be maintained, and this record is maintained in a logbook. Now, the value of the fringe benefit is calculated according to paragraph 7, subsection 4 of the 7th schedule, and can be divided into 3 parts. There is an employer-owned or leased vehicle with no maintenance plan. This is so you own the vehicle as an employer, the company owns the vehicle, but they are leasing it out, and that vehicle doesn't have a maintenance plan. In that instance, then the fringe benefit amount is 3.5% of the value, the determined value of the motor vehicle, and this is a monthly fringe benefit, by the way. A monthly amount which must be included in that individual's payroll. Option number 2 is where the employer-owned or leased vehicle has a maintenance plan. In that instance, then the amount is reduced to 3.25 as opposed to 3.5%, and that is the fringe benefits amount that is included in the taxable income for that medical practitioner or that individual. Option number 3 is where vehicles held by the employer under an operating lease, in other words, with a non-connected lessor. And in this case, the fringe benefit is the actual cost. In other words, you're renting the car. You are not buying, you haven't purchased the car via debt and paying it off in monthly installments, but rather you are renting the car from a non-connected third-party lessor. And so the fringe benefit is the cost of that under the operating list, plus the cost of fuel in respect of the vehicle. The value of the fringe benefit can be reduced, as I said, on assessment where accurate records have been kept with respect to actual business kilometers. And so this is calculated on a pro rata basis. So these costs, the business costs, are limited to the ratio that represents the business kilometers as a ratio of total kilometers traveled by the vehicle in that particular year. Again, if this sounds a little bit too complicated, I think it's worthwhile having the conversation with your accountant, and this is just to put you in the right direction or to create awareness that there is something like that, and then you can explore it further. Now, a travel allowance is any advance granted or an allowance paid to the employee or by the employer. In this case, remember, you might be the owner of that business, but if you maintain a payroll for yourself, in other words, you pay yourself a monthly salary, in that context, you then become the employee. And so a travel allowance is that amount that is granted by your business for the use of your vehicle for business purposes. And so the travel allowance is calculated on the basis of actual distance traveled, and it can either, you can elect to have a fixed amount paid on a monthly basis or a reimbursable allowance paid for actual costs incurred. So if you don't want the admin of having to, on a month-to-month basis, calculate a reimbursement allowance, then reimbursable allowance, then you can pay yourself a fixed travel allowance. But there's going to be reckoning at the end of the year, and we'll touch on that a little bit further. Now, a travel allowance. So a travel allowance is a fixed allowance which is given as a fixed amount to an employee towards traveling expenses for business purposes. Now, these amounts are normally paid as part of the employee's remuneration, or together with the other elements of your remuneration package. And the travel expense deduction is granted on an allowance for business travel and can be determined rather using actual figures. So what we're saying is, out of that amount that you're given as a travel allowance, the actual travel, business travel, can be determined or calculated and used as a deduction to reduce the taxable allowance. Now, the taxpayer can provide actual business expenditure figures which are acceptable to the tax commissioner, and to do so, the taxpayer would have to keep a detailed record of all business expenditure. I think we've emphasized this quite a bit already. It is important to note that travel between your home and place of work cannot be claimed as business travel, but is rather regarded as private travel. In order to claim a deduction, the first step is to record your vehicle's odometer reading at the beginning of each tax year, which is for South Africa the first day of March. For each year for individuals, and then also record your odometer reading for that vehicle on the last day of February the following year, which is the last day of the tax year for individuals in South Africa. Now, the distance between the closing and the opening odometer readings will give you the total kilometers traveled for that year. Now, without these readings, you cannot claim a tax deduction. So once you've taken down these readings and worked out your total travel for the year, you can start calculating the travel deduction. First, you need to calculate what portion of the total kilometers traveled was for business use, and it is compulsory to keep a logbook of all your travel in which you record your business kilometers if you want to claim a travel deduction. Otherwise, the Revenue Authority will disallow your travel claims. The logbook must contain the date of travel, the kilometers traveled, the travel details, where to, and the reason for the trip. The tax implication for both the right of use of a car in the case of a fringe benefit as discussed earlier and the fixed travel allowance are the same. 80% of the allowance paid and or taxable benefit to an employee will be subject to employee's tax, or if the employer, so the SARS gives the employee two options. Either they can elect that 80% of the travel allowance is taxable if they feel that only 20% of their travel is business, or if they feel that 80% or more or less of their travel is business, then they can elect to have 20% of their tax being of that allowance being taxable. Obviously, the reality is that there would be a variety of options within the spectrum between 0 and 100, but SARS only allows you to elect between these two options. The reason being that the actual reckoning happens at the end of the year when the taxpayer is submitting their tax return. Now, we want to briefly mention some recommended apps that you can use to track your mileage. Find out, it is worthwhile to experiment with them and find the one that you're comfortable with. Again, we haven't mentioned all of them, but it's up to you to really research and find the ones that work for you. We've got Connected Team, we've got Everlance app, and Mileage. So do your research and find out what works for you, and it's worthwhile as well to have the conversation with your accountant. Quite a lot of information there. I know, like I said, have this conversation with your accountant. We're just creating awareness. We're going to talk about the reimbursable travel allowance. Now, this is when the employer pays back the employee's expenses which they have incurred while traveling for business. What is a reimbursable allowance? It is an advance. It is an allowance, rather, or advance paid on actual business kilometers already traveled by the recipient and is paid out at the employer agreed rate per kilometer. Now, two requirements need to be met. Firstly, the allowance is based on actual distance traveled for business, and in today's environment, that's not difficult to determine in advance because you just need to check that out on your GPS. And then secondly, no other travel allowance or reimbursement is payable to that employee. Those are the two conditions. Now, if the taxpayer does not have proof of actual expenditure incurred or business traveled, or if they do not have proof of actual expenditure incurred, then a deemed cost of R4.64. Again, this is for the 2024 tax year, which started on the 1st of March 2023, and that rate is published every year by the finance minister, but in this year it is 464 per kilometer. So this is the rate that you can use per kilometer, but a new rate is published every year, as I have indicated. In terms of Section 68 of the 7th schedule, a taxable benefit is deemed to have been granted when the employer contributes directly or indirectly to the medical scheme on behalf of the employee and his or her dependents. Similarly, an employee is deemed to have been granted a taxable benefit by his or her employer if the employer has made contributions or paid any amount to the pension or provident fund on behalf of that employee. And then insurance payments, again, business-related insurance payments are deductible from the business. However, any personal insurance costs or premiums, such as insurance cover for sickness, hospitalization, and incapacity, are not tax deductible. And also, if that is paid on behalf of the employee, that is a fringe benefit. The plus side, though, is that the proceeds paid under these income protection policies are in most instances tax-free. Home office expenses. Now, working from home can save you travel time and overhead expenses. In addition, SARS allows you to claim a pro rata portion of your home expenses, such as insurance costs, water, rates and electricity, repairs and maintenance, home telephone accounts. Remember we said that if the business use is greater than 50%, the business can pay the entire telephone account, cleaning costs, as well as mortgage bond interest. Now remember, just the interest portion, not the capital portion. It is important to familiarize yourself with the home office criteria that qualifies for deductions. And so there is a guide that SARS has published, and it is quite prescriptive and clear. You should also be aware that claiming home office expenses on your primary residence means that you might lose out on a portion of your exclusion from paying capital gains tax should you sell that primary residence at some point in future. Therefore, this is one of those proceed with caution areas of tax planning that needs the advice of your tax expert or your accountant. So quite a lot to take in. I hope that this has been insightful. If you have got any questions, follow-up questions, please feel free to get in touch. And you can get in touch on any of the platforms indicated on your screen. Otherwise, it's been a great interaction with you, and I look forward to interacting with you on future videos. Thanks and goodbye.